Microsoft just did something no software company has ever done. It earned more than $100 billion of net income in a single year. $101.8 billion, to be exact, on $281.7 billion of revenue. But the real story isn't the size. It's that growth is speeding back up, while Microsoft spends more on building data centers than any company in history. The question is simple. Is the AI Capex supercycle earning its keep? Start with the top line. Revenue climbed from $198 billion in fiscal 2022 to $281.7 billion in fiscal 2025, compounding at more than 12% a year. For a company this size, the usual story is that growth slows down. Microsoft did the opposite. Fiscal 2025 revenue grew almost 15%, the fastest annual pace in this whole stretch. And then it accelerated again. In the March 2026 quarter, the latest 10Q, revenue jumped more than 18% year over year to $82.9 billion, up from $70.1 billion. Net income that quarter rose 23%. When a company worth nearly $3 trillion speeds up instead of slowing down, you pay attention. Here's what makes Microsoft different from almost everyone else spending on AI. The margins are going up, not down. Gross margin held near 69%. Operating margin expanded to 45.6%, up from 42% 3 years ago. Net margin sat at 36%. Think about that. Microsoft is pouring tens of billions into AI infrastructure and still widening its margins. Return on equity ran 33%. Where does the money come from? 3 segments: productivity and business processes, which is Office, Microsoft 365, and LinkedIn, brought in $120.8 billion. Intelligent Cloud, the home of Azure, did $106.3 billion. And more personal computing, which is Windows, gaming, and search, added $54.6 billion. Stitch the cloud pieces together, and Microsoft Cloud alone generated $168.9 billion. And this is the engine. Azure and other cloud services grew 40% in the latest quarter. Microsoft's AI business is now running at a $37 billion annual run rate, up 123% in a single year. That is the fastest growing part of the most valuable franchise in software. But growth this fast is not free. Watch these two numbers move in opposite directions. Capital spending, the purchases of property and equipment, jumped to $64.6 billion in fiscal 2025, up 45%. Operating cash flow was a massive $136 billion. Yet free cash flow after capital spending actually fell to $71.6 billion, down from $74.1 billion the year before. Net income rose 15%, and free cash flow went down. That is the whole tension in one line. So what is all that spending buying? 2 things. First, a backlog. Contracted revenue not yet recognized, what Microsoft calls remaining performance obligation, hit $627 billion, up 99% year over year. That is more than 2 years of total revenue, already under contract. Second, adoption. Microsoft 365 Copilot crossed 20 million paid seats, with seat additions up 250%. The bull case says this capital spending is simply catching up to demand Microsoft has already booked. All of the financial data in this analysis comes from the company's actual SEC filing, pulled directly from the RoboSystems shared data repository. If you want to run your own queries on any public company's filings, check out robosystems.ai. Now, valuation. And here's the surprise. For most of the past 3 years, Microsoft traded around 31 to 33 times earnings. Today, it trades closer to 22 to 24 times forward earnings. the stock has quietly derated by about a quarter. The market reacted to the capital spending surge by paying less for faster growth. Microsoft is no longer priced for perfection. Put it in a scenario model and treat these as illustrative ranges under stated assumptions, not price targets. A bear case, where the AI spend underdelivers and margins stay pressured, implies a value around $157 a share. A base case, where capital spending normalizes and AI monetizes, lands near $338. A bull case, where the supercycle pays off, points to roughly $444. The stock trades around $367. In plain terms, the market is paying for a successful Capex cycle, but not a euphoric one. So, is the AI Capex supercycle earning its keep? The honest answer is, not proven yet, but the early evidence is strong. Watch three numbers. Azure's growth rate is 40% durable or supply gated. Free cash flow, does it inflect back up? And that $627 billion backlog, does it convert into real high-margin revenue? Get those right, and today's derated multiple looks like a gift. Get them wrong, and the bear case stops being hypothetical. This is a framework for watching the bet pay off, not investment advice.